Morning, guys. Happy Friday. It's May 23rd, 5:28 a.m. Central Time. Grain markets pretty quiet this morning, quiet overnight trade. Brian Split is here wearing a very nice sweater. Brian, you look good as always.
Thanks.
Let's start off, guys, with yesterday's action in the corn market.
So the front month corn contract rose for the fourth consecutive session yesterday. The July 25 contract gained 2 cents, settling at 463 per bushel, supported by technical trading. The deferred contract months, however, edged lower due to a firmer US dollar, weaker crude oil prices, and mostly favorable crop conditions. Rain is forecast across the Corn Belt in the coming days and is expected to aid crop development. Also on Thursday, the International Grains Council raised its forecast for next season's global corn production by 3 million metric tons, bringing the total to 1.3 billion metric tons.
So those are the official explanations that McKenzie gave, and none of those really make a whole lot of sense for me. So, Brian, in your opinion, why have corn futures closed higher for 4 consecutive days?
I think we, number one, got a little overdone to the downside. We made some lows while we were in the delivery period for the May contract, which is a common event. I think we went back in that 436.5 low. If you go all the way back to prior to August in July of last year, there was a shelf around that 435 to 437 area. So we did test some very good technical support. I think you've got some areas in the growing region that are the market's concerned about planting. I've got a client in Missouri that has a pretty sizable crop insurance book, and I was talking to him a couple of days ago, and he was just telling me how the amount of claims for prevent plant or failure for corn and for cotton, and this was in Missouri, Arkansas, Tennessee. So I think that's part of the market, and then you've got Ohio. Ohio's well behind pace. So I think there's some areas that where the general planting pace as a whole for corn and beans is really good, but there's definitely some pockets of concern. We were able to retake the 200-day moving average this week, so that trend resistance at 480, the 100-day is right there at about 479, and then if you did the retracement from that February high all the way to the May low, 50% is right at that area as well. So I think you got three major technical reasons to go back up to that. And I think the high on May 1st was 480 as well.
A couple things that I might add would be strong export sales, which we'll get to in a minute.
Mm-hmm.
Also, farmer movement's pretty slow. I mean, the board, despite the rally, the board prices still aren't great. You've still got a planting campaign, so you're seeing some basis pushes. But the market X, well, let's do the same thing for soybeans. Here's a soybean chart. We've kind of consolidated. It would appear to me that above this July contract, you've got kind of a big resistance area from that 1082 up to maybe just north of 11. I don't know.
Yeah. So recently, I think soybeans have performed pretty well as far as the month of April, maybe the back half of the month. We were testing the same area over and over again. So 1037-ish, 50-day was there. That gave us that push up to the highs that we had earlier in the month. And then the most recent set of lows, there's about 4 days of lows here before this little pop that we've had. Those are all against the 200 and 100 days. So market's holding these moving averages nicely. The thing I think just to bring about again is that soybeans on a front month basis don't like trading at the $11 price.
Mm-hmm.
And so I think this is going to be a really key area, because my concern is that if we're not overtaking $11, let's say by the end of June, when this June contract or this July contract is going into delivery, I think that means we probably have already seen the seasonal high and we're going to work our way back down. If we can push through $11 on a front month basis over the next 30 days or so, I think that means the market's going to try and go to 12 or 13. So I think we're at a really, really critical area where this market needs to accelerate.
Here's wheat. We've seen a little bit of pop in the wheat market also. I pulled an HRW chart. Maybe you've got some trend resistance here near 570 or so. It's still a downtrend though, isn't it?
It is, within this trend. I mean, that's the top peak to the next peak. You could draw a downtrend from that second peak to the third peak and say, all right, well, that downtrend's been violated, or the third peak to the little fourth peak down here. But yes, the big picture, long-term downtrend, we've yet to get through that. I think it's also really important if this wheat market's going to recover further. We had sets of lows, and again, you go all the way back to August of 2024. where basically that 550, 555 area was holding. That was the low end of the range, and 650 was the upper end of the range. So this contract needs to reestablish itself over that 550 area. And you could see that as we progress into the later part of the month, that trend line is going to come in right in that zone. So I think it's another market where it feels good. We made a good little short-term low, but we haven't really gotten through the key resistance.
All right, let's jump to weather and specifically the drought monitor.
So much of the Corn Belt received rainfall last week, but drought conditions saw only limited improvement. Notable relief was observed primarily in south central Iowa and northwest Missouri. Meanwhile, several areas across the region received below normal precipitation, leading to worsening conditions in Indiana, Illinois, and Minnesota. Rainfall was scattered across the High Plains last week, with precipitation totals reaching 400 to 600% above normal in some areas. This led to notable improvements in drought conditions across the Dakotas, Nebraska, and eastern Kansas. When we look at the percentage of U.S. areas experiencing drought, corn country 20%, soybeans 17%, winter wheat 23%, spring wheat 38%, and cattle country 29%.
Brian, I'm going to show you a slide here. It's two maps side by side, and I really hate myself for doing this, and I apologize, and I'm an idiot, and I'll never do it again. But this is the current drought monitor versus the same week in 2012. There's been a lot of drought talk this year. I'm not predicting that this is going to happen or repeat itself, but there's some similarities, especially the drought in the Western Corn Belt or parts of the Western Corn Belt like Iowa, but maybe more specifically the stuff in the Southwest.
Yeah, you could argue that it's worse in 2012 in that respect. And I'm not a weather guy. I just try to understand what the weather guys are watching and talking about and how, why that matters. And that dryness, that pocket in Southwest Texas that creeps west from there, that's the thing that eventually could start to travel north into the growing region. And there's certain conditions that are required for that to for that to happen. Apparently, the water temperatures off of the coast of California and Baja, Mexico, really could be the driver. So if those temperatures go cold and continue to cool, then that generally puts the dome right over the Midwest. If those water temperatures don't get cold and warm up a little bit, then that dome is generally right in California and Nevada off the West Coast, right? So that's a big part of this, is where that dome eventually sets up over the summer. But yeah, I mean, there's no way for us to predict. I just try to be mindful of what the forecast is. But I think the way the forecast looks moving forward for the month of June, it seems like we're going to start having some moisture deficits start to build. A lot of these maps I've seen this week have, called for 1.5 inches to as much as 4-inch deficits for the month of June. So if that's the case in the month of June, I think this market's going to start getting pretty excited.
Let's look at some weather stuff. So there have been some fairly widespread rains across the Corn Belt over the last 7 days, and this is good or bad depending on where you're located. If you're in the West and it's been dry, these rains are welcome. If you're in Ohio and you don't have anything planted, the rains obviously were not welcome. The next 5 days, you've got a lot of the Corn Belt that's going to be dry. You've got kind of call it the southern or southwest part of the Corn Belt. Missouri and parts of Kansas will be a little bit wetter. And then you go to the 10-day period, and you've still got some drier stuff for Indiana and Ohio, which I think is welcome. I think they need to dry out in those areas. But you got rains coming for the Western Corn Belt. One different view would be this. This is a map from our friends at Crop Profit based on Euro model data. They say that U.S. corn country in total will see 87% of normal rainfall, but you're reverting back to below normal rainfall for a lot of areas. And you can, still have rains, and you could have rains now and still have a drought later. I mean, it's possible, or run into dry conditions later. It's just, I don't know that I'm seeing it right now,
I mean, we brought up 2012 because that map was up there, but the market.
I'm sorry again. I apologize.
The market in 2012 didn't know there was a drought until like mid to late June, and then it was like,
well, that's when the market traded it.
Yeah, and then it hit the market over the head, and then we were just opening up limit higher on Sunday nights in the month of July. So you're right. This market, these moisture maps, moisture profile maps, drought monitors, there's a little bit of lag time in between, when you get the rain and then when it shows up on the map. And it's going to take a while for the map to dry out a little bit too after not getting rain for a while. But I think about some of these weather events like that drought in 2012 or all the flooding in 2019. If you remember that, how long we were flooded, and it was like for a month and the market didn't care. And then all of a sudden it did, and it cared a lot.
Yeah, for sure. All right, let's go to the rumor mill.
Yesterday, rumors circulated that the Trump administration would grant a number of backlogged small refinery exemptions. The SREs, if granted, would result in reduced biofuel production. Soybean oil futures traded sharply lower following a late recovery. EPA later denied the rumors and said that they could be an attempt to manipulate RIN prices. Volatility in the soybean oil market continues amid swirling biofuel headlines.
Seems like the bean oil market's been like the bus driver here with the soy complex, which is not really normal, but you're seeing like all these back and forth biofuel headlines. The mandate's going to be this, the mandate's going to be that. Now you got SREs. No, you don't. I mean, we don't know, but it still looks like a decent looking chart to me. I don't know.
It does. I think bean oil above 50, especially if we close the month above 50 on July, that would be a pretty big victory. And you had said it's not typical for bean oil to be the leader. I think things have also changed. I mean, it used to be the meal market that needed to be the thing to get the bean market going, and I just think the market's different now. We've transitioned into a market that cares a lot more about renewables. That's going to be the main demand driver. Is why are we building all this extra crush capacity? It's not to make more meal.
Yeah, 100%. Let's go to the tax bill.
The U.S. House of Representatives passed President Trump's domestic policy package on Thursday with a vote of 215 to 214. The multi-trillion-dollar legislation now moves to the Senate, where it faces significant challenges as several Republican senators have indicated that major revisions will be required to secure their support. The Congressional Budget Office estimates that the bill will add about $3.8 trillion to the federal government's $36.2 trillion debt over the next 10 years. Investors are concerned that the bill will cause federal deficits to grow rapidly and hurt the country's long-term financial stability. The 30-year Treasury yield briefly rose to 5.17% on Thursday, its highest level in nearly 20 years.
I talked about the bond stuff in detail yesterday, but I would like Brian's opinion. So this 30-year Treasury bond made some fresh lows just yesterday prior to a recovery. Brian, explain to people how big of a deal this is.
Yeah, the bond market's it's bigger than the equity market.
It's the biggest. The debt market's the biggest market on the planet.
So when you have the bond market breaking down, and that was something that the trade was really concerned about in early April as the equity market was breaking down. So this big drop that we had from 122 to 112, that got everybody really concerned. And so we did take out the lows from January again before recovering, but I think the major low that the traders are going to be watching is a low that was made. I think it was in December of 2023. And I was down around 107, and that was a level. I think if we eventually take out 107 on the bonds, then we're going to start to see a little bit of mayhem in the financial markets overall. But yeah, the bond market is when we think equities, and the other day I think it was mentioned that the buying from retail was the biggest ever for that day at $4.1 billion. And the bond market is so much bigger than equities. And if we have troubles in the bond markets, it's what happens is it dries up liquidity everywhere. And that's what we had happen. Like you think back to 2008, when we start getting some of these instruments where liquidity dries up, then it affects all the markets that we trade. So I think it's really important for this bond market to catch here and not continue to break down. Hopefully we made a nice big double bottom here from January and May lows, and we can start working our way back up. That'd be a lot healthier for the market as a whole.
As I mentioned yesterday, some people who are smarter than me, my friend Jim Urio in particular, believe that if the bond market or treasuries get much worse and interest rates get much higher, that the Fed will ease again. And by easing, I mean the Fed will step in and buy treasuries, and that will be seen as a positive for commodity markets and probably negative for a lot of other things. It's kind of like a money printing inflation type trade. Does that make any sense to you?
Yeah, I mean, it just basically starts that path of the quantitative easing and change in monetary policy. And if they start buying bonds and It seems like interest rates need to go down, and that's the beginning of that inflationary cycle again.
Yeah, and you're seeing it. You're seeing it in some markets. There's some markets like you look at the Bitcoin market. You look at gold. I mean, there's some indications that maybe the market's concerned about that sort of thing. Let's go to export sales.
U.S. corn export sales declined last week, but remained strong. Net corn sales were reported at 47 million bushels. The print was down 29% compared to the previous week and 14% from the prior 4-week average. Japan was the largest corn buyer for the week. Net soybean sales surpassed pre-report expectations at 11 million bushels. The print was up 9% from the previous week, but down 10% from the prior 4-week average. Mexico was the largest buyer. Net wheat sales saw reductions of 500,000 bushels. The print was down substantially from the previous week and from the prior 4-week average. Colombia was the largest wheat buyer for the week.
Let's go to corn sales, and I'm going to read you, Brian, what I wrote in my email this morning. I wrote this. Some analysts argue that USDA is 100 million bushels too light with its current marketing year export projection for corn. At the same time, many continue to argue that feed demand must be overstated in order to justify the lack of price strength. It feels like everybody's going to agree now. I mean, it's almost June. USDA is probably needs to adjust exports. But there's got to be something else wrong, right? Because the corn market doesn't really act that great, and current prices with July futures at 462, that doesn't line up with a 1.3 carryout. It just doesn't.
No, 1.3 carryout. The stocks to use that would imply down in the low 9s to upper 8s, and now you're starting to talk, carryout and stocks to use levels that should be, $6 plus corn, not mid 4s. And so I think there's yes, we look at the export pace, the sales that we continue to have, and I keep hearing 75 to 100 million bushels that needs to be adjusted higher on the balance sheet for corn for export. We just saw, the USDA where they've made these revisions before, where you raise exports and then lower the feed residual, and again with the amount of cattle inventory, continuing to reduce feed residual makes sense. I think there's also the possibility that maybe the USDA overdid the reduction in yield in the January report. And maybe there was just a little bit bigger crop than what they said. And so you're right. The market is not trading from a flat price and from spreads. I mean, if we're trading a 1.3 type of a carryout, the July should not be trading less than 10 cents over the D's. We should be trading a 30, 40, 50, 60, 70 cent inversion at that point.
Okay, so if you had to guess, the people who are arguing lower feed usage and perhaps USDA is now understating last year's crop, are they right, or are they just scrambling to produce a reason for the lack of price strength? And people are always trying to find a reason, right? Like
right.
The market's not doing what it should be doing, so there's got to be a reason. Is there?
I don't know. We think about like back to last fall where the spreads were doing things and people are like, wow, that's interesting. And then all of a sudden we learned that the yield wasn't quite there. So are the spreads telling us something now that we don't know? What it is, we don't know yet. And we'll be told at a later point. But I think the spreads are saying right now, unless they really start to get going here, something happens, that the carryout's a little bit bigger than what we think it might be. And I think, again, the feed residual makes sense, but I think it makes a lot more sense. And you could probably account for a lot more on the balance sheet by just saying the crop, they made it too small, and it's probably a little bit bigger on a yield perspective from last year's harvest.
Or could it be that the trade believes that corn acreage this year is really 96 and a half, 97? Could it be that simple?
I don't know, because I think if it was the case of, hey, we do have a 1.3 and it's big acres for next year, then I think you would see July trading a lot higher relative to December. So if it was a 1.3 old crop carryout and 96 and a half million acres of new crop corn, I think July would be trading quite a bit higher than relative to December than what it is now, if that was the particular reasoning.
We'll find out the reason for the lack of price strength in corn eventually. I don't know that we know today.
Or corn may just be about to run higher. Who knows?
Let's go with that. Let's go with that idea for today. We have one more story about wheat. Let's go there.
India is projected to harvest a record wheat crop this season. According to the USDA, production is expected to reach an all-time high of 117 million metric tons. India's farm ministry, meanwhile, estimates the crop at roughly 115 million metric tons. Favorable weather, combined with the use of climate-resilient, high-yielding seed varieties, has supported strong crop development. If realized, the bumper crop would raise India's wheat stockpiles to a 4-year high and likely put pressure on global wheat prices. In light of the strong production outlook, flour millers are urging the government to lift their ban on wheat product exports, which was implemented back in 2022 following a severe drought that reduced yields.
Well, this sucks because we were hoping for like trade deal with India and purchase agreements, and I just don't know that that's going to happen. India is a huge consumer of wheat, but they're largely almost totally self-sufficient. They don't really import much. They don't really export much. They're just kind of there. And it would be cool if they imported some wheat. I was told maybe they'll import some ethanol. I don't know.
That's what I think would be cool, and I think that's a lot more likely. When you think about what a lot of these developing nations are looking for, ethanol is a big part of that. But in India and their wheat story is interesting because you mentioned that these would be 4-year highs in their wheat stocks, and they had kind of told the world after Russia invaded Ukraine that they'd be there to help make up some of that difference. And then all of a sudden, their stocks were tight, and they are restricting exports. So it's just one of those things where the pendulum swings in both directions. And so a couple of years ago, when they were making up the slack, and then they had a problem with their own crop, that caused things to get very tight over there. And then when things get very tight, then production increases, and that's just the normal cycle of what we do.
Yeah. All right, Mackenzie, what cattle do yesterday?
Live cattle saw gains ranging from $1.47 to $2.15. Feeders were $3.22 to $3.65 higher, with the exception of the front month contract losing 90 cents. We do have a cattle on feed report coming out today. Cattle on feed as of May 1st are estimated at 98.5% of year-ago levels. Placements in April are projected at 96.8% versus last year, and marketings last month are forecast at 96.7% compared to last year.
Correction over, Brian, or more downside?
I don't know. I mean, that reversal that we had really only gave us the day of the reversal and then one follow-through day. The one thing that's maybe a little concerning to me is that the live cattle are recovering a lot better than the feeder cattle market are. We had August feeder cattle gap lower on that day 2 of the correction, and we've still yet to get through that day 2 high, where live cattle are several dollars through their day 2 high. So I don't know what's keeping this feeder cattle market from recovering like live cattle, but that's kind of a concern to me. I think, again, we're at record levels. Could the market break further at any time? Absolutely. I think anybody involved in the cattle market needs to have some type of coverage. But I don't know. I don't think the fundamentals have changed. They still look awfully friendly to me.
All right, guys. Have a nice weekend. Have a peaceful Memorial Day, which is Monday. We will be off. No videos, nothing from us. We'll be back Tuesday. Brian, thanks for joining us. We'll be back Tuesday.